Hey guys, it's Ross Hardy from the Hardy team at Remax Marketing Specialist. And as you know, each week I'm trying to break down some of the key talking points and matters in the real estate market. And this is no exception this week. And this is probably the most common question I'm seeing asked online and in person from our clients at the moment. And that is, when is the real estate market going to crash, or when is the bubble going to burst? And it's not just in this market that people are asking that question. In the last week on Google, searches for that very thing have gone up over 2,400%. So it's definitely a question that's on everybody's lips. Now, depending who you ask, you might get a stock answer such as, I really don't know. No one can predict where the market goes, but I'm going to stick my neck out and make a couple of predictions here based on what we're seeing as far as the inventory levels go and the demand goes, how we got here and where it looks like it's likely to go going forward. So let's start with the basic market conditions. We all know it's based on supply and demand. So let's first take a look at the supply, where we are and how we got here. So we know that nationwide, the real estate inventory supply is less than 1 month. And that's also the case here in Hernando County, where we just crept under 1 month of inventory in the county here. Now, how do we get here? Well, first of all, if we take a look at what home building has been in the US over the last 50 years, we will see on average that we tend to build around about 725,000 homes per year in the US. Now we can see the uptick here leading towards the great real estate market of 2004, 2005, and then the strong dive off the cliff after that in the Great Recession, where there was a drastic shortage in the number of homes being built. In fact, there was only around 300,000 or 400,000 homes being built during that time. And you can see the uptick towards the recent years, where we're finally back above that point of inflection, as Hank Sorensen calls it, of 725 to 750,000 homes. But what that's meant is the compounded effect of not building enough homes over those years is that we're about 5.5 million homes short of the level that would be required to maintain just the regular people moving due to death, divorce, debt, job relocation, and so on and so forth. So one is the number of homes that have, or rather have not been built over the last 10, 15 years. And the reason that home building hasn't picked up quite as much as it could have done recently is the number of jobs in the construction took a dive as well after the market crashed in 2006. Those people left the industry, didn't get back in there, and so without the ability to replace those workers, homes are not being built at the rate required to again catch up with the inventory needs in this market. The second one is the resale inventory is down. So National Association of Realtors said that from January 2020 to January 2021, there was nationwide a 40% drop off in the inventory levels. Realtor.com just announced that in January of 2021, there was a 14% reduction just in that 1 month. So you have the 40% year on year and then an additional 14% after that. So that tells you exactly where we are inventory wise. It's at historic lows. What that means is that we are seeing about 42% of the homes listed sell above asking price at the moment. That's not at asking price or above, that is above asking price. So very low inventory here, guys. Now let's take a look at the demand side of things. Demand, we know, is at historic highs. Part of it driven by the fact that there's a scarcity mentality. But also, we know on average there's about 5.25 to 5.5 million homes sold per year in the US just through natural progression. The estimates for 2021 is 6.49 million, with 2022 being about 6.44. So we're looking at about 1 million homes more per year than the regular demand. What's driving that? Well, we have the normal, like I said, divorce, debt, death, births, relocations, and so on and so forth. But let's take a look at some of the other factors here. We also have record high credit scores in the US. People's credit scores have never been higher than they are right now, meaning that although we're not in the easy money subprime market that we were in 2004, 2005, more people are able to obtain loans. Then let's take a look at the US savings rate. Well, we have an average here across the history of the US and the amount of money being saved. It normally tapers off around 9, 10, 11%. That dropped down to about 2.2% in 2005. And then what happened when COVID kicked off in April of 2020? That number jumped right up and spiked when people did not go out anymore, didn't go to the cinema, restaurants, so on and so forth. It capped out at 33%. and is now back down to a rate of about 13.6% for February of 2021, which is still 3, 4, 5 times higher than the rates of 2005. So that's why we're seeing very, very strong cash offers or heavily cash strong offers in the marketplace. These people are not going to be defaulting on these payments when they're putting down $100, $150, $200,000 like they were in 2005 where there was subprime lending. So we're not going to see these homes going into foreclosure. I did touch on the foreclosure moratorium ending last week and the effect that might have. But again, we're looking at maybe about 15% of the foreclosures that we had back in the Great Recession. So that's not going to see the prices dropping off. We're not going to see that huge inventory of short sales and foreclosures coming into market. And it also explains at the moment why regular home buyers who don't have that strong cash to put forward are not being successful in this market because they're getting beat out by these people. And then finally, one aspect that's completely unique to this real estate market is the effect that COVID has had on housing demand. Now, it's estimated that before the outbreak, about 7% of the US workforce either were working or were able to work remotely. The best estimate for when the dust settles after COVID is that it will be about 25% of the US workforce. Now, what does that mean? Well, in a workforce of about 160 million workers, that means that number jumps from 11 million to 40 million people that are able to work remotely. Now, let's just say that 25% of this 29 million additional people that are able to work remotely, which may be a conservative number, is looking to move home. That is an additional 8 million people in the home market buying, selling phase. So you can see how that vastly changes the demand for the market and is a strong driving factor at the moment, particularly in an area like Florida, where people are looking to get out of high traffic, high cost areas where they were previously required to be for work. So LA, San Francisco, Chicago, New York, and those types of places, and move into, you guessed it, areas such as Florida. So we're likely to see a much higher proportion of that demand in areas such as this. So guys, hopefully that makes sense as to why we have low inventory, just how low it is, why it's likely to stay low in the future, and then the high demand, exceptionally high demand, how we got there and why it's likely to stay high, if not increase as time goes forward. So I'm going to stick my neck out and say that this real estate market is not going anywhere for the foreseeable future. Now, what might happen is it might change in the makeup, such as once these people who have a high amount of cash or complete cash to buy these properties have satisfied their demand, we will see the opportunities for FHA or heavily financed buyers to come back in and fulfill their demand. Of course, the prices will likely have increased at that point. Just the numbers I pulled the other day tend to indicate that in Hernando County, we're looking at about a 4 or 5% increase in prices over the next 30 days once the current pending deals close out. So you can see how quickly this market is changing. Guys, as always, if you have any questions about the real estate market, feel free to put them to me and I'll answer the best ones. I'm Ross Hardy with the Hardy team. Thank you for watching.